Okay, so you want to own a real estate business. Buy properties, watch them appreciate, collect rent along the way, and let the market do the heavy lifting while you build generational wealth. Sounds simple. It is not simple. Here's the problem. Almost none of that is how this business actually works. And by the end of this, you'll understand why most real estate operators fail, not because they picked the wrong properties, but because they never understood the actual business they were in. Let's start with the entry fee, because real estate business covers a much bigger operation than a single rental property. A serious real estate operation, running a portfolio large enough to be a genuine business, something like 15 to 25 properties across residential and small commercial assets, typically requires $3 million to $8 million in total acquisition capital, including down payments across the portfolio, at standard commercial lending ratios. And that's just to acquire the properties. You need a legal entity structure, usually multiple LLCs, to isolate liability across different assets, costing $15,000 to $40,000 in setup and ongoing legal fees. You need property management infrastructure, whether that's hiring an in-house team or contracting external management, running 8 to 12% of gross rental income depending on portfolio size. Add renovation and stabilization costs for properties that need work before they're rentable, typically $200,000 to $600,000 across a portfolio this size, and you're looking at real operational capital of $3.5 million to $9 million before the business generates a single dollar of stabilized cash flow. Here's the first trap almost nobody sees coming. Most real estate operators finance acquisitions through a mix of conventional mortgages and commercial loans, and nearly every one of these loans includes a debt service coverage ratio requirement, typically demanding that each property generate at least 1.2 to 1.25 times its mortgage payment in net operating income. This sounds manageable until interest rates rise on your variable rate loans or a property sits vacant longer than expected, because falling below that ratio doesn't just hurt your cash flow, it can trigger default clauses that let lenders call the entire loan due immediately, even if you've never missed a single payment. New operators routinely discover this the hard way when a single problem property threatens to cross default across their entire portfolio because of how their loans were structured. Now let's talk about what happens after you actually start operating, because the operating bleed across a real estate portfolio never stops moving regardless of market conditions. Property taxes across a 20-property portfolio typically run $300,000 to $600,000 a year, depending on jurisdiction and assessed values. Insurance, especially with rising climate-related risk in many markets, costs $150,000 to $400,000 annually across the portfolio. Maintenance and capital expenditure reserves, the professional standard being 1% of property value annually for ongoing upkeep, plus additional reserves for major systems like roofs and HVAC, run $300,000 to $500,000 a year. Property management fees, if you're using a professional management company, consume another 8 to 12% of gross rents, easily $200,000 to $400,000 annually on a portfolio this size. Vacancy and turnover costs, even in a well-managed portfolio, typically account for 5 to 8% of potential gross rent lost annually. Here's the economic reality that will define your entire career in this business. Your fixed costs scale directly with portfolio size, but your income depends on occupancy and rent growth in local markets you don't control, and those two things rarely move in perfect sync. Here's the part the passive income dream skips entirely, and it's the part that actually explains why this business exists in the first place. A real estate business does not primarily make money from rental income. It makes money from leverage, appreciation, and tax strategy working together over time, in ways that rental cash flow alone could never achieve. Understand this, and you understand why sophisticated operators think in decades, not years. On a typical stabilized property, monthly rental cash flow after all expenses might represent just a 4 to 6% cash-on-cash return annually, unremarkable compared to other investments. The real wealth engine is elsewhere. Leverage means you control an asset worth far more than your actual cash investment. So even modest appreciation of 3 to 4% annually on the full property value can represent a 15 to 25% return on your actual equity invested. Depreciation, a paper expense allowed under tax law even as properties often gain real value, can shelter significant rental income from taxation, sometimes reducing your effective tax rate on that income to near zero for years. And tenants paying down your mortgage principal each month builds equity that belongs entirely to you, functioning as forced savings you didn't have to fund yourself. The monthly rent check is the product on the surface. Leverage, appreciation, and the tax code underneath are the real business. Now let's follow one property and see where the actual wealth accumulation happens. You purchase a $400,000 rental property with $100,000 down, financing the remaining $300,000. Annual rental cash flow after all expenses might net you just $8,000 to $12,000, a 8 to 12% cash-on-cash return that looks decent but not extraordinary. But that same year, tenants pay down roughly $6,000 of your mortgage principal, building equity you didn't have to save yourself. The property appreciates at a modest 3.5% annually, adding $14,000 in property value, which represents a 14% return on your actual $100,000 investment. Depreciation deductions might shelter $3,000 to $5,000 of that rental income from taxation entirely. Added together, and the property that looked like it generated a modest $10,000 cash return actually created $30,000 to $35,000 in total wealth that year, 3 to 4 times what the cash flow alone suggested. So let's run two versions of the same real estate business and see how differently this can play out. In the optimistic scenario, your 20-property portfolio maintains 95% occupancy. Local markets appreciate a steady 4% annually, and rent growth keeps pace with rising property taxes and insurance costs. Combined annual net operating income across the portfolio reaches roughly $850,000. After debt service of $620,000, you're clearing approximately $230,000 in annual cash flow, while the portfolio's total equity, combining appreciation and principal paydown, grows by roughly $900,000 that same year, representing genuinely substantial wealth building, even though the cash flow itself looks modest relative to the portfolio's total value. Now, here's the realistic scenario. Using the exact same portfolio, the exact same starting assumptions. A regional economic slowdown increases vacancy across your portfolio from 5% to 14%, while simultaneously, 3 of your variable rate commercial loans reset to significantly higher interest rates as their fixed rate periods expire. Insurance premiums, driven by increased climate risk assessments in your market, rise 35% at renewal. 2 properties require unplanned major repairs, a roof replacement, and a foundation issue, costing a combined $85,000 beyond your normal reserves. Your net operating income falls to just $520,000, while your debt service actually increases to $680,000 due to the rate resets. That $230,000 optimistic profit doesn't just shrink. It becomes a $160,000 annual cash flow deficit, forcing you to inject personal capital to cover mortgage payments, while property values in your market stagnate, meaning the appreciation that normally offsets weak cash flow simply isn't there that year. The operators who actually survive and thrive in this business long-term aren't the ones who acquired the most properties the fastest or chased the highest advertised cap rates. They're the ones who structured their loans to avoid cross-default risk across the portfolio, who maintained cash reserves specifically sized for simultaneous vacancy and rate reset scenarios rather than average conditions, who diversified across multiple local markets rather than concentrating risk in one region's economic cycle, and who understood from the beginning that cash flow was never really the point. Appreciation and equity building were. A real estate business, at the end of the day, isn't really a rental income business at all. It's a leveraged, tax-advantaged wealth accumulation vehicle wrapped around property management, where the loan structure and reserve planning built years before a rate cycle or regional downturn ever hits decide who actually survives long enough to see the portfolio through to real wealth.